Well, thank you for joining us. I appreciate everybody coming. It gives us a chance in research to see all of you that we generally see only once a year. So it's nice to reconnect and say hi. Hi. Last year I spoke in detail about our investment process and how we identify and capitalize on what we call value gaps. Today I'm going to quickly review the value gap because it provides the proper background for the main subject of my talk today, and that is recognizing structural shifts and how that impacts our investment process. So you've often heard us talk about themes in the past, and we have done it in general terms for the most part. But today I'm going to dig through three structural shifts that we've recognized, the themes that are associated with those structural shifts, and then I'll relate that to several portfolio holdings that we have in all your accounts. So now for the refresher. Last year I spoke about the importance of having a methodology or a framework for knowing when to buy and sell stocks. We talked about and walked through our HMA, the process that we use, how we look at a worst case analysis, formulate a worst case price, a buy point, a sell point. And we use this, the way I did it is illustrated this process by using a series of slides, which was designed to show how our process is designed to capture those value gaps. It allows us to capitalize when the price of a stock becomes disconnected with the underlying value of the business. In those slides, I used Apogee Enterprises as the example company, which we'll do again today. In our process, we have 14 valuation metrics that we use, but today I'm going to isolate just on one, and that is tangible book value and the price to tangible book value. There may be some that aren't familiar with the term, so let's review that quickly. If we start with the total assets of a company and then subtract the total liabilities, we end up with book value, also referred to as shareholder equity. From that, if we subtract off all the intangibles, which is goodwill, trademarks, and patents, we'll arrive at tangible book value. If you take tangible book value, divide it by all the shares outstanding, you end up with tangible book value per share. So we look at tangible book as a very good proxy for the underlying value of the business over time. It doesn't equate to the intrinsic value of the business, but it's a great measure or a gauge to the growth of the business and the direction of the underlying value. So here we look at a graph of tangible book from Apogee Enterprises from 1990 to present. And we can see that while Apogee is somewhat cyclical over time, it's grown quite nicely over the last several decades, and with each peak being higher than the previous peak. On this next slide, we see the price of Apogee Enterprises for the same time period. And we can see that the price is far more volatile than the underlying business. It's gone from 5 to 30, back down to 5, up to 30, down to 10, back up to 30. And you can see it's far more volatile than their underlying business when we compare it to the book value in this next chart. So here, not only do we see that the price moves up and down more significantly than the underlying value of the business does, but it does so more frequently as well. It's these wide and frequent price moves, also known as volatility, that gets investors so nervous. However, when we look at it very closely, we can see that it doesn't matter how scary the economy is, or how ugly the headlines are, or how nervous investors are. Every time Apogee hits 1 times book, 1 times tangible book, during times of maximum pessimism, it's the bottom. Here we combine both the price and tangible book into a ratio. By doing so, we're comparing the price of the company to the underlying value over time. So at the bottom we see, again, Apogee is selling at 1 times tangible book, which is labeled the value zone. At the peak it sells at 3 to 4 times book, which we've labeled the expensive zone. So by evaluating price in combination with value, we can see volatility isn't something to be feared, but can be something we can cheer. So why would we cheer it? Well, because when people are more concerned about price than they are value, when a price declines, they end up selling a stock irregardless of when it becomes a great value. Well, basically, they're handing us a gift. On the flip side, though, when everything's rosy and everything's looking up, these same investors pile into the stock, driving the stock up to the higher levels, at which point we're very happy to sell it to them. So you can see, at this point, not only did they hand us a gift at the bottom, they were gracious enough to double that favor and buy it from us at the top at a premium price. Now, if that's not something to cheer about, I don't know what is. Okay, so now let's move on to the main subject of my conversation today, and that is understanding structural shifts and the impact that this has on companies. So it's one thing to understand the current value of the business, and we use history as a guide, but we also want to understand the future of the business. So we have to assess what is going to happen to the future of that company and that industry. In order to do so, we look at structural shifts. So we know that the dynamics of world economies, regulation, competition, and the ingenuity of the human spirit are all subject to dramatic shifts and dramatic change. This leads to structural shifts, which then reshapes economies, reshapes industries, reshapes companies, and within that, we're looking for those game-changing events. Because in that event, the winners will grow in excess of GDP while the losers decline. So recognizing these structural shifts, we develop themes. From those themes, we look through the winners and losers and buy companies. We want to, of course, look for those that are going to win and avoid those that will lose. Determining these winners and losers, of course, has a dramatic and direct influence on the future prospects of industries and companies, such that the winners will gain competitive advantage, they'll see increased revenues, increased profits, and their asset prices will rise, while the losers will have a weakened competitive position, they'll lose market share, revenues and margins decline, as will their asset prices. The implications on the valuation in total are also profound. In this next chart, we see a typical company where the stock price moves up and down through a rather consistent valuation band, much like the Apogee Enterprises, selling at 1x tangible book at the bottom and 3 to 4x tangible book at the top. In that case, and with Apogee, there's no real structural shift in the business, so the stock will move up and down relative to the valuation band throughout an economic cycle. On this next chart, however, we see what happens when a company wins the structural battles. Not only do they see the rising profits gaining market share, but the entire valuation structure moves higher. So you've heard us talk about trying to find the next bull market, and that's what we're in search of. Well, this is the picture that I have in mind when we're saying we're looking for the next bull market. The opposite, of course, is true for the losers. Not only do they see declining fundamentals, but their entire valuation structure moves lower and lower. So you see declining fundamentals and declining multiples as well. This is also known as the value trap, and certainly something we try to avoid like the plague. When looking at the sources of structural shifts, we have found that they are generally due to a combination of several things. Government regulations is probably one of the top. Globalization, demographic shifts, government policy shifts, change in the Federal Reserve policies, and of course the adoption of revolutionary technologies. So now let's walk through 3 of the structural shifts that we see, the themes that we have identified, and we'll relate that to portfolio holdings that we have, which in total represent about 25% of the portfolios. So beginning with the first structural shift, that came out of the housing crisis, as well as the Basel III and the Dodd-Frank banking regulations. The themes that we have associated with that are the recovery in the housing market and also the impacts that those regulations are having on the mortgage servicing industry. The second structural shift comes from advanced drilling technologies, the revolutionary technology that's impacting the energy markets. Our theme there is the energy renaissance, but more specifically the impact that that is having on several industries. And then the final structural shift is one with globalization and a technology evolution in the container ship business and the impacts that that is having on sea-based logistics. So beginning with a housing recovery theme, you'll remember in 2011, Arnold spoke in great detail about the housing market and the pace of the recovery that we saw then. We felt that the housing market was bottoming and that over the next several years that the new builds would gravitate back up to that 1 million unit per year average that it had been at for so long. We certainly held a minority view at that time. Most analysts on Wall Street were advising investors to either avoid the industry entirely or sell their stocks. They provided us a gift once again, and we gladly accepted it, buying several housing stocks during the second half of 2011. And as this chart shows, the housing market did in fact bottom in 2011, and that recovery has gained speed. Our investments in MDC, Toll Brothers, Universal Forest Products, and Fortune Brands have all paid off quite nicely. And of course, after shunning the builder stocks in 2011, Wall Street is now back in, buying them, quite giddy, in fact, from the beginning of the year. Of course, that's after all these stocks have doubled, tripled, or more. The Wall Street Journal even had an article where they had a picture of a house and all the items that go into a house and suggested these are the stocks that folks ought to be buying to benefit from the recovery. This excitement, of course, pushed stocks to higher levels, so much so that it had discounted the recovery too far into the future. Those stocks hit our sell points. We sold those stocks. We still think there's legs to the housing recovery, and we continue to expect the opportunity to present itself where we can buy these same stocks back. And whenever it does, when these stocks get to our buy points, we will happily buy them again. In response to the severity of the housing crisis, the industry has seen a slew of new banking regulations. And this is causing a significant structural shift in the mortgage industry. And as a result, we see an opportunity to buy the specialty mortgage servicers. To understand this shift, however, we have to go back a little bit and look at the structure of the industry prior to these new banking regulations. This is a chart that represents the flow of a typical mortgage payment. So when a mortgage payment was made, it would go to the bank, and that bank also operated as a mortgage servicer. Now, that mortgage servicer is the administrative function of separating that mortgage payment into taxes, insurance, and principal and interest. In the old structure, the bank not only acted as the lender, but was also acting as the mortgage servicer. But thanks to these new regulations, the industry structure has now changed, such that the mortgage servicing, or that administrative function that was previously done by banks, is now being replaced by a group called specialty mortgage servicing companies. There's $10 trillion in mortgages outstanding in the United States that require servicing. This graph shows the dollar value of the mortgages that have shifted from the banks to the specialty mortgage servicing companies since the housing crisis as a result of the new regulations that have come forward. You can see in 2008, this is a standalone business, and it was virtually non-existent. Currently, there's $1.1 trillion of mortgages that are being serviced by these specialty servicers. And over the next 5 years, we expect that to move to $2 trillion, which would be about 20% of the outstanding mortgages. You can see with this transition from the previous mortgage servicers or the banks moving to the specialty mortgage servicers, those that can perform that new function should fare quite nicely over time. Well, Kenny Domeleys, our housing analyst, recognized this shift in the second half of 2012. And he spent the next several months digging through the details of this new industry. It was new. There wasn't a lot of people that knew about it. He searched out consultants and other people in the industry to find out what it involved. And it became very evident through Kenny's due diligence that there was several things that were quite important. First, the barriers of entry were quite high and difficult. Every executive in these specialty mortgage servicing companies has to be approved by regulators in every state. In fact, in a conversation with the CFO of one of these companies, he's been fingerprinted 100 times so far this year. It was also evident that the regulations were forcing the banks out of the business. They didn't necessarily want to get out of it, but they were forcing them out of the business, which meant that there were forced sellers. It also meant that those that were buying it were getting great deals. He found that there was only a handful of companies that could do it. The processing infrastructure required was quite significant, and there was not too many people that had that infrastructure in place. So what we found was that the structural winners were going to be, there wasn't many of them, and they would see significant benefits as this transition occurred. Those companies are Ocwen, NationStar, and Walter Investments. In December of 2012, we began buying NationStar, and over the next several months, we bought Ocwen and Walter. As a package, these companies are up 25%. In addition, we're tracking several other opportunities in the mortgage financing business, and we hope to add those to your portfolio, and we'll keep you posted on our progress there. Let's look at the next structural shift, and that is the advanced drilling technologies that are impacting the energy market. Horizontal drilling and hydraulic fracking has truly become a game-changing event for this industry. It's really hard to overstate just how significant this has been. It's resulting in American energy renaissance, not only changing North American energy markets, but also impacting world energy markets. In this map, we're showing the shale reserves of the lower 48. Much of these reserves were previously uneconomical just a decade ago. It's not that the reserves weren't there, mind you. They've always been there. But we didn't have the technology available at the time to economically extract these oil and gas reserves out of the ground. But thanks to these advanced drilling technologies, we can, and it is opening up this huge reserve base in the United States. With the adoption of these advanced drilling technologies, the industry has seen tremendous increase in productivity. In this graph, we show the total U.S. production of oil and gas since 1973 to present. In 1973, we produced 19.5 million barrels a day of oil and gas. And since that time, we are in steep decline through 2006, where we bottomed at 13.5 million barrels a day. And in the last 7 years, with this productivity gains, we are now back up to 19 million barrels. Actually, I was reading last night, we are now 21 million barrels a day, so we've now surpassed the 1973 levels. This is all thanks to the advanced drilling technologies, and it is changing the world quite significantly. So not only are we producing more, but we're also importing less, and this is changing the structure of the world energy markets. Here we're looking at the reversal of net imports of oil and gas for the United States. After having peaked in 2006 at 14 million barrels, our net imports are now down nearly 50% at just less than 8 million barrels a day. Now, many of you may remember the 2006-2007 timeframe where the talk was we're at peak oil and we're going to run out. Well, there was a story at the time of a Saudi prince who was commenting about peak oil and the impact that was having on his family's favorite mode of transportation. In this article, he was talking about oil, but one of the things that stuck out to me is his comments about that. He said his grandfather rode a camel, his dad drove a car, and I have a plane. My grandson will be back on a camel again. Well, I'm not sure whether he really believed that or not, or if he was talking his book. You know, he sat on a lot of oil, so, you know, feeding the frenzy at the time and pushing the price of oil up, you know, served him pretty well. So maybe he was just looking to upgrade his plane. But what we all know is his grandson is not going to be back on a camel and riding that to work anytime soon. But the conversation now has changed 180 degrees. We're now talking about being a net exporter of energy. In fact, we're now exporting natural gas, whereas before we were opening up LNG import plants. We have 100 years' worth of natural gas in this country, where just a couple years ago we were thought to be running out. It's amazing what technology can do to solve issues. And this is certainly changing the world energy markets. The huge increase in natural gas production is also leading to lower prices of natural gas. And we can see that in this graph. Here we compare the price of natural gas around the world in many countries. The bright blue line is the price of gas in the United States, amongst the lowest around the world, with the exception of the Middle East, whereas most other countries are selling at $8 to $14. Our natural gas is priced at $4. As a result of the advanced drilling, and the benefits that the U.S. has seen, many countries are now desperately trying to match the success we've had in the U.S. Because of advanced drilling, but they're coming up short for several reasons. First, countries like Japan and Korea, well, they have no shale, so that's a no-starter for them. In Europe, property laws are such that the owners of property don't own the mineral rights, so there's no way they're going to let people drill on their land if they get no benefit. So it's not going to happen in Europe. China does have shale, but it's very difficult. They have a lot of clay in their shale, so it makes a gooey mess when you try to extract it. On top of all that, All of them lack the equipment, expertise, the know-how, and the infrastructure. So even if they try, it's going to take them many years to acquire these assets and be able to exploit the drilling technologies and increase their natural gas production, which is creating a significant and long-lasting advantage for the United States, and it's going to benefit those in the United States that use natural gas. So now let's look at who benefits. Certainly the U.S. consumer is going to benefit because of lower utility bills, but so do many manufacturers. And this is, by the way, is one of the key factors in the American manufacturing renaissance, because many manufacturers use natural gas as input or costs. In particular, fertilizer companies, pulp and paper companies, steel mills, tire and rubber plants, liquefied natural gas export business will benefit, and so will pipelines. But today we're going to concentrate on the chemical industry, because the chemical industry has the distinct role of being the largest industrial gas consumer in the country. So by looking at the chemical industry, we know that ethylene is king in the chemical world. By volume, ethylene is the most widely used petrochemical throughout the world and serves as a key building block in the production of other value-added chemicals, such as PVC, vinyl chloride, ethylene glycol, styrene, polystyrene, and that then is used to make a variety of consumer goods like adhesives, tires, shoes, bottles, windows, flooring, you name it. Ethylene itself is produced in a process called cracking, which is done either by using naphtha, which is an oil-based derivative, or ethane, which comes from natural gas. Now here's what gets really exciting. In the United States, 70% of our ethylene production is done from natural gas, or ethane, where in the rest of the world, that's reversed, where most of them use a naphtha-based or oil derivative. So the low-cost gas in the United States is creating a significant competitive advantage for the domestic ethylene producers. By looking at the global cost curve among major nations, here we're going to look at 2005. This, if you recall from the previous chart, this is when natural gas was at high levels in the United States. Notice on the far right, the United States is at the highest ethylene cost among the major nations, making ethylene and, by extension, the U.S. chemical industry uncompetitive relative to its international counterparts. This also explains why many companies were offshoring production, because they wanted to get closer to their raw materials providers. It also explains why we shut down many plants over the last decade. As a result of the energy renaissance, we're seeing a major shift in the ethylene cost curve. Today, here is 2012's cost curve, where you can see the United States is very significantly advantaged relative to all but the Middle East. Notice China, Europe, and Northeast Asia all have ethylene costs of 80 cents a pound or higher. And that compares to the United States ethylene cost of roughly 30 cents. So at less than half the cost of China and Europe, and only slightly more than the Middle East, this is driving a significant structural shift within the ethylene business, which is producing positive implications for not only the producers, but also the consumers of domestic chemicals. As a result of the domestic chemical producers, they're gaining share, and they find themselves needing to add capacity. On the opposite side, the foreign companies, the foreign chemical companies, are losing share, and they'll remain uncompetitive unless they shift production to the United States, and we'll likely see some plant closures in Europe. So in order to meet all this future demand, the domestic chemical industry is now embarking on the largest spending period we've seen in the last 20 years. We've been tracking the pace of this chemical build-out ever since we identified this theme more than 2 years ago. And each year, the estimates for the chemical build-out has increased. Based on data from the Industrial Info Resources, that's a third-party company that tracks this, there's currently $73 billion that's going to be spent over the next 5 years, and that number is going to approach $100 billion in the next 7 years. This spending wave is creating a great opportunity for us to invest in companies that will benefit from this spending that's occurring in the industry. As Arnold mentioned, we like to invest in the picks and shovels. Well, in this, it's the parts and pieces that go into chemical industry. Here we take a look at an overall chemical plant and where that $70 to $100 billion is going to be spent. 9% is in the engineering services, 43% is spent in the equipment, and 48% is spent in the construction materials and the labor. Breaking it down further, that 9% in the engineering services will result in an additional $6 to $9 billion of revenues over the next several years just due to the chemical build-out. Now, these companies also will benefit from the paper mills, the rubber mills, the steel plants, but just to the chemical industry, it's $6 to $9 billion of additional spending. Companies that we have that will benefit from that are Jacobs Engineering and CDI. We bought them both several years ago. 42% of the pie is represented by the equipment companies. And this group is expected to see an additional $30 to $43 billion in incremental spend. Here we own Powell Industries, Encore Wire, and a group that we've labeled top secret. Well, we're trying to buy these stocks, or we're close to buying these stocks, but just in case anybody in here wants to get a little jump on the action, we'll hold off revealing the names until we've bought them. The next 48% is the labor companies, the construction material and labor companies. We see $33 to $48 billion in incremental spending. Portfolio holdings here are again CDI and Jacobs Engineering. They're involved in the construction as well, but also Insteel and Orion Marine. Additional companies in the portfolio that will benefit are Granite, Emerson, and Aztec. Now, by looking at this chemical build-out geographically, we see that while the chemical projects are planned throughout the United States, the majority of them will be built in the manufacturing centers of the Gulf Coast, the Midwest, and the East Coast. This also happens to correlate nicely with the population density of the United States and will add jobs, increase incomes, provide support for additional businesses, and it's close to local manufacturing consumers, so it's going to lower the cost of freight, which will improve the competitiveness of U.S. manufacturers. All this will add positively to these local communities in these regions, which provides the next step in our next phase in this theme, which we are in the middle of exploring, and we'll keep you posted as that progresses. Now let's look at the third structural shift today, and that's globalization and the evolution of containerized shipping and the impact that that is having on sea-based logistics. So we've all seen these big boxes that are on the back of trains or in the ships. And this is, you can call it a box or a container, or the technical term is a TEU, which stands for 20-foot equivalent. But whatever you want to call it, this box has really changed the world, especially with regards to globalization. Now, containerization, the idea of it was the brainchild of an entrepreneur named Malcolm McLean. He was an entrepreneur and an East Coast trucking magnate. He believed that if you package goods in standardized containers, it would save money and time by being able to move it from a truck to a ship back to a truck again. And in 1956, he tested this theory. He moved 58 containers from New Jersey to the port of Houston on a retrofitted World War II tanker. At that time, loading and unloading was done by hand, and often the ships spent more time in the ports than they did at sea, so he had a vested interest in seeing this work. Well, on that maiden voyage, McLean's theory proved out. He reduced loading costs from $5.83 a ton to 16 cents a ton. With that stroke of genius, global logistics was forever changed. And at that time, the writing was on the wall for those that were looking, especially for Freddie Fields, who was the head of the Longshoremen's Association. That's the union that's responsible for the loading and the unloading of these ships. Well, when he was asked what he thought of McLean's new container ship, he said, well, I'd like to sink the son of a bitch. And did he try? He and the entire industry tried through years of lawsuits and countless strikes. But even though they tried, 10 years later, McLean, after the introduction of McLean's container ship, the world internationally adopted it. And as you can see in this chart, along with that adoption, global growth grew dramatically. Here we're looking at a chart of world merchandise trade. And from 1966 to 1983, the number of container ports grew from 1% to 90%. And this dramatically expanded global growth. For the 35-year period from 1966 to 2000, that's the year just before China entered the World Trade Organization, global trade increased 7 times. And after China was in the World Trade Organization, global growth increased 2.5 times. So you can imagine with this kind of growth, the shipping companies had to respond. This next chart, we look at the evolution of container ships. In the early days of container ships, the largest available ship could hold 500 to 800 of those containers, or TEUs. By 2000, just as China was entering the World Trade Organization, the largest available ship at that time was 8,000 TEUs. Just recently, the shipping company Maersk unveiled an 18,000 TEU ship. This increase in capacity is driven by 2 primary factors. First was the need for the shipping companies to respond to the pure volume and the demand volume because of the growth. And secondarily, because the economies of scale in the shipping industry dictate bigger ships because it lowers operating costs. Now, up until recently, this evolution to bigger and bigger ships was really constrained by the desire and the ability of the shipping companies to fund the increased ships, as well as the shipyards, the technical ability to build the ships. But now, geography is starting to play a role. Beginning in 1996, the largest available ship at that time was too big to pass through the Panama Canal. So in response, the Panama Canal authorities drew up a plan to expand, widen, and deepen, and add a 3rd set of locks to the canal. This expansion is set to be complete in 2014. But with the evolution towards bigger ships, that Maersk 18,000 TEU ship is once again showing that the largest available ship won't pass through the canal. Again, geography is playing a significant role, and it is impacting shipping routes. Now, to put this size of this 18,000 TEU ship into perspective, take a look at this. It is about the size of an Empire State Building. Now, looked at it from another way, if all 18,000 of those containers were filled with tennis shoes, it would hold 111 million pairs of shoes. That's enough to put on the feet of every citizen in Mexico. That's just one ship. But it's not stopping there. Soon there'll be a 22,000 TEU ship. Why 22,000? Not because it's a round number, but because that's the current geographical limits of the Suez Canal. So, as shippers continue to push for bigger and bigger ships to meet the demand and to lower their costs, it continues to put severe stress on the sea-based logistics infrastructure. Which brings us to our next theme, which is the widening and the deepening of the Panama Canal and the impact that that is having on U.S. ports. So as bigger ships are passing through the canal, these ports have to and will see substantial upgrades. They need to deepen and widen their ports in order to accommodate these bigger ships. There's currently $3.6 billion set to be spent over the next 4 to 5 years in order to deepen and widen these ports. That is 2 to 3 times larger than the average spend for deepening. Now, we're using a bit more conservative estimates. We think it's going to take a bit longer than the 4 to 5 years. But nonetheless, when we combine this deep porting that's happening, plus the normal maintenance work that is required for seaports, along with the maintenance that is needed up and down the Mississippi River, plus the marine construction work that needs to be done because of the chemical build-out, plus the marine construction work that needs to be done because of the LNG terminal work, we see an industry that is going to be far short of the assets required to service all this, which means it's going to be a tight market. We'll see higher revenues, higher income, and higher asset prices. To capitalize on this, we've bought 2 port dredging companies, Orion Marine and Great Lakes. And we have another group, top secret, which we are not about to say, because we see this as a substantial opportunity. When we do buy those, you'll see them in your portfolio. Now we look at the second phase of this structural shift, and that relates to the overall impact that this is having on logistics. As these bigger ships pass through the Panama Canal, it changes the economics of shipping. and it's certainly altering the industry and is going to produce new winners and new losers. This map represents the economics of a 4,000 TEU ship, which is roughly the average size of a ship that passes through the Panama Canal today. This black line represents the break-even line. In other words, for those areas that's left of the black line, it is cheaper to ship to and from the West Coast. But for those areas that are right of the black line, it's cheaper to ship to and from the East Coast. That 46% number represents the population density to the right of that black line. As we look at what happens when an 8,000 TEU ship passes through the Panama Canal, we see these economics change dramatically. You see the black break-even line? It will mean 63% of the population will have a cost advantage from shipping to and from the East Coast. This shift towards the larger population density and manufacturing centers will certainly shift the decision-making of logistics companies and shippers. And this is going to have a wide range of impacts from distribution centers, warehousing, truck, rail, as well as many other industries. But there's still too many variables that are yet to be determined for us to definitively say who the winners and losers are. But we are certainly tracking this because we see it as a great opportunity. As we have more clarity and as we find those opportunities, we'll certainly be adding stocks to the portfolio to benefit from that. So whether it's shifting government policies, new regulations, revolutionary technologies, or an entrepreneur like Malcolm McLean developing an ingenious new idea, change is inevitable. And when we see changes, it impacts the structural, we see structural shifts that impact economies, companies, industries. It's with this understanding that we build our portfolios. We identify these shifts, we sort through the winners and the losers, we use our disciplined investment process to buy and sell stocks. We are excited about all these themes, all these companies, as well as many other themes and companies I haven't mentioned today. I look at structural shifts much like a great Disney film, where when you identify a great theme, it produces the opportunity for multiple sequels. I expect that as these themes evolve, they will produce multiple offshoots, many more stock ideas, and yes, even some great blockbusters. Thank you very much.